Folks, if there's a group of stocks that traders hate, it's one that I'm about to tell you today. Short interest. That's right, short interest. Or the percentage of shares that traders are shorting. It's astronomical. In some cases, up to 45% of all shares outstanding are being shorted. It's just huge. Let's jump into this hot topic today and discuss it. Folks, I want to talk to you about open interest, short interest, float, and all of these other sentiment type of tools that I use. And I'm going to make this really important. I'll explain to you why I'm doing this. There's been a lot of controversy lately. So what we're looking at right now is a chart of the increased open interest, short interest. Now, what is short interest? Short interest is the amount of shares that are short. Imagine that, right? Yes, there's actually a sentiment indicator that you can get. A lot of trading platforms, all the exchanges. This is not complicated to get. You can get your hands on it. And if you still can't find it, just contact me and I'll tell you how to do it. But what we're looking at is we're looking at the number of short shares in comparison to the overall shares outstanding, the float. Not shares outstanding, because shares outstanding, not all shares outstanding are tradable, but the float is. But I'll get into all of this in a minute. So I want to explain to you why I'm showing you this and the difference between how I do it versus how a lot of these CNBC guys do it. And I want to explain to you that not a lot of real traders do this. So here's the difference. A few weeks ago, Tesla shares went up. And no, I'm not going to talk about Tesla today, but I want to use that as an example. And one of the reasons that a lot of the analysts said that it was going up was because it was a short squeeze. All the short traders were getting stopped out, and that's why the stock was going higher. And they made this conclusion based on the fact that in their analysis, they thought that the shares, that Tesla had a lot of short shares. Well, the problem with the way they analyzed it was they looked at the dollar value of the shares, and then they looked at the dollar value of the short shares, and they compared those two ratios. That's not very accurate because, as we know, Tesla can sometimes move 50, 100 points in a day. So the value of the stock is distorted because it's based on investors' expectations. So a better way to do this is to take the float, all the shares that are outstanding that are tradable, not shares outstanding, but are tradable shares, which is the float, and then take all the short interest shares. So for example, to make this really simple, let's say the float is 100,000, okay? And let's say that the number of shares short is 10,000. Well, 10,000 out of 100,000 is 10%. So 10% is short. It's that simple. That's the ratio. Let's say, for example, 20,000 stocks were short and the float is 100,000. Then 20% of shares are short. The bottom line is it's a very simple equation and it compares apples to apples because you're actually looking at all the shares that are tradable and then you're looking at all the short interest that's available. So you're not looking at the value of the stock because that can implode, explode. You're not looking at the value of the short shares. Doing it by value is just dirty and it's not clean. But you know, if you were to take Tesla and you were to analyze it the way I'm teaching you right now, you would only find that about 13% of the shares were short. So it really didn't have a lot of short interest. So again, it's more accurate. Now, why am I talking about it? Why am I bringing Tesla into this? Well, I thought about this and I figured that a lot of investors and traders don't realize that this is the best way to figure out where the shorts are looking at, what they're looking at, how they're analyzing the market, and so forth. So I want you guys, and the reason I brought this sector up is because the retail sector makes up a huge, huge, huge percentage of our GDP. Remember, 20 years ago, 30 years ago, Amazon was just selling books. They weren't even around 30 years ago. But my point is, brick and mortar stores were the basis, the cornerstone of American economy. And they still represent a huge percentage of our GDP. Now, online stores are also retailers, but I wanted you to look at traditional brick and mortar stores. And I wanted you to see how their short open interest as a percentage of float has been increasing, especially between 2018 and 2020. The last 2 years, they've been increasing. Notice, I don't have to say anything. All you have to do is look at the chart. For example, Bed Bath & Beyond, 43% short interest. That means 43% of all shares are taking a short position in the stock right now. That's eye-opening, right? That's eye-opening. How about Children's Place? You're talking about 46%. Why? Well, most of it is because all of these transactions are now on Amazon. People are buying home products, pillows, blankets. They're buying it on Amazon. I'm doing it on Amazon. I know that most people here are buying it on Amazon. We just moved to a new office and we literally bought everything from Amazon. So again, Dillard's. Look at Dillard's. You've got in 2018. You've had about 25%. You have now 34% shares that are short. So investors, hedge funds, are increasingly shorting the retail sector. So the question's going to be, and I'm going to be monitoring this over the next few weeks, but the question's going to be, is this going to spill over into the internet retail sector, or is it going to remain in the brick and mortar sector? So far, it's only in the brick and mortar sector, but I wanted to bring this to your attention because this is a very important clue as to what may happen over the next few months. If this short interest continues to increase, we're going to see more volatility and we're going to see weakness in the retail sector. And as I said, the retail sector can generate as much as 70% of the GDP, which is the number one indicator of growth in our country. So this is very important and is something we have to pay attention to, because if this increases, we may have a very choppy market environment. I'm sure the Fed is looking at this. I hope they're looking at it with the same ratios I am. And again, I'm taking the float and I'm taking the percentage of the float that is made up of short interest. Again, I hope this helps, and I hope you see how eye-opening this study is, because it really drives the point home of the increasing bearish sentiment on the brick and mortar retailers that once dominated this country. Hope that helps. Folks, I've got something really big for you. Pay attention, this is important. The retail sector accounts for 70% of the GDP. That's right, the GDP. That means it accounts for 70% of our economy. And to be honest, to be practical with you, I think the market's about to hit a pivot in the next 197, 200 days or so. And that means retail sector is going to be critical to all of this. But it's just one part of the equation. To prepare myself and you for all of this, I've put together a comprehensive report called Diamond Roadmap. It takes you through how I see the next few months playing out and how you can take advantage of it with the right strategies at your disposal. I honestly, in good faith, think we can make more money in the next 200 days than most investors make in a decade. Click the link below, get my Diamond Roadmap now. Don't wait.